beginning of this video that the key thing that we're budgeting for when we prepare a budget is the profit and loss account budget. And when people talk about the budget, they're often referring to the profit and loss account budget only when they use that term, the budget. So I just want to remind you of what goes into a profit and loss account, what the basic structure is. So a profit and loss account will have revenue in there, call it revenue, call it sales, call it turnover. Your income will always start with that. And then we will have our direct costs. They're the direct costs of making your sales. And if you want a little example, I'm going to use this example throughout the video, actually. What about the example of someone running something very simple business, a coffee shop or a chain of coffee shops? So that the direct costs of the sales that we're making will be the cost of the coffee and the cost of the milk and the cost of the wages of the person who's actually making that. So they'll be the key direct costs. And we'll take our revenue less our direct costs, and that will give us our gross profit, our big profit, our profit before deducting those overheads. And then we'll deduct the overheads, and the overheads will be things like the rent of the shop, the cost of cleaning the coffee shop, and so on. Yeah, maybe the electricity as well. That will go in our overheads, and we'll deduct our overheads, and then we'll get our operating profit. And remember, operating profit is, if you like, an old-fashioned term. It's the one I still use, but it's often replaced with the term EBIT, this acronym, earnings before deducting interest and tax. Earnings before deducting interest and tax. So EBIT, the operating profit. And actually, when you do your budget, that's the key bit of the profit and loss account budget. That's the bit that will be given to the managers within the organization, because that's the bit of the budget that the managers of the organization can control. I'll add the other couple of bits just for completeness. You'll also deduct interest and tax. So you can budget for the level of interest that you're going to be paying. Obviously, that'll be very important, certainly for your relationship with the bank and also for your cash flow budget, because it will feed into there. And the taxation that you'll pay. And if we deduct those two things, then we'll get our net profit, or as it's also known, our earnings, because that net profit is the profit that the shareholders have effectively earned from the business. So that's what a full profit and loss account looks like. But please remember, the key bit that we'll be budgeting for, that we'll be using on a day-to-day basis in the business, is that bit down to operating profit. So that's what your profit and loss account budget looks like. And then on the next slide, I'm going to show you something about cost behavior, because when we're budgeting for that profit and loss account, it's really useful for us to know or appreciate that certain costs behave in certain ways. And that helps us when we're producing our budget, helps us produce our budget more accurately. Okay, let's have a look at that. I want to talk to you now about something called cost behavior, the way that costs behave. Now, when you prepare a profit and loss account budget, remember, that's the key budget that everything else is driven by. There is one critical budget factor. And in almost all organizations, whether they're private sector or public sector, that key budget factor is actually income. It's actually revenue. If you're in the public sector, then that income will be derived from government usually, and it'll be a figure that you're told, this is how much you're getting for the next financial year. If you're in the private sector, you'll have long exercises working out what your markets are going to be like next year, how many customers you're going to gain, how many customers you're going to lose, what prices are going to be like, how many locations you're going to open, and so on. And that will be a very long and detailed exercise for you to decide how much revenue you think you're going to get. Now, once you've decided that, when it comes then to budgeting for the costs, because we know how certain types of costs behave, budgeting for those costs can be something that we can do a little bit more accurately based on that revenue, because we understand how the costs work. And I'm going to categorize the cost behavior into three types. You may find textbooks that say there are 4 types or 5 types, but I'm going to use 3 for simplicity here. So the 3 types of costs are, first of all, the fixed costs. I'm going to use my cafe example again. So the fixed costs are the costs that don't change. So they don't change over the period for which you're budgeting. So they stay the same. So it's like a straight line moving through the year. Doesn't matter how many customers we have in the coffee shop. Doesn't matter whether we've got 100 customers a day or 200 customers a day. As long as we can all fit them all into that shop space, then these costs won't change. So what sort of thing am I thinking about in the coffee shop? Well, the rent won't change. The level of rent that we pay will not change. The business rates we pay won't change. The lighting cost won't change. If you've got a light bulb, then that will light the shop, whether you've got 10 people in, 20 people, 50 people. Those costs are fixed costs. Okay, so they're fixed costs, they don't change. Secondly, we've got the variable costs. Now, these are the opposite. The variable costs vary with output. So for each extra customer, then you've got an extra cost. Every time you get an extra customer, these costs rise. So in the coffee shop, great example would be the cost of the coffee or the cost of the milk. Every extra customer that comes in that buys a cup of coffee, then you've got to pay for that extra coffee, that extra milk. So they're variable, they rise. You can see the arrow going up from left to right as the number of customer rises, then this cost rises. And the third category of costs, very common actually in modern businesses, the third category of costs, I would refer to them as semi-variable. So they do change, but they don't change every time we get a new customer. And another way of describing these is as stepped costs. I like that description because it really does give you the image of what's actually happening there, stepped costs. So you can see the step going, over a period of time, the costs stay the same, and then all of a sudden they jump up. And they stay the same, and then they jump up again. An example of a stepped cost would be the staff costs. So what you might find in your coffee shop is that you've got 3 members of staff working there, one making the cappuccinos, one making the sandwiches, and one serving. And when you've got 100 customers a day, you've got 3 members of staff. 120, you've got 3 members of staff. 150, when you get to 150 customers a day, then you need an extra member of staff. It's just too busy for 3 people to cope, and so the staff costs jump up. They go in that step. They even until you get to 150, and then at 150 they jump up and you need an extra staff member, and everything will be good until you get to 200 customers, and then you need to jump up again. So that's how the stepped costs work. And by understanding this, then it helps us budget more accurately. If we understand that a cost is a fixed cost, that's easy to budget for. If we know what the rates bill is, we don't worry about it. We put it into the budget. It doesn't change no matter how many customers we've got. We have to be careful though. We do have to understand what those fixed costs are. I gave you an example, and I did it on purpose earlier, about lighting. So yeah, the lighting of the shop, if you stay open for the same period, that's probably going to be a fixed cost. But sometimes with costs like that, they will change. So what would happen, for example, if the electricity company decided that they were going to put the cost per unit, the cost per kilowatt hour up? Or what would happen if you decided that you were going to open for an extra 2 hours every evening? Then those costs would actually go up. So you need to understand what category your cost fits into, and some costs will absolutely fit into the fixed cost category and never change, like your rent. But other costs you might have to query. So understanding your costs is really, really, really important, and understanding how they behave is really important so you can get accurate budgets. You know, what happens often is you change things like your revenue, and then you have to think, if you're in finance or if you are a person who has been asked to provide information to finance, once you change things like revenue, then you're going to change some of the costs. You're going to change some of the step costs. You're going to change some of the variable costs. So as you go through your budget process, understanding how those costs work will help you react. When figure 1 changes, you might have to change figure 2. Anyway, that's enough about this. That's enough about the way that costs behave. Just useful for you to know. And as a manager, you're never probably going to be asked to budget for fixed costs, but you will be asked for information that's going to help budget for stepped costs, semi-variable costs, and variable costs. That's where the finance team need your help, yeah, so that you can tell them how many units of coffee you're going to use per year, what the cost of those units is, how many staff you think you're going to have at different levels of customers within your coffee shops. Okay, let's move on. And in both of these videos, we're going to finish with a couple of multiple choice questions just to check that you've understood the subject matter covered. So let's have a look at those now. Okay, so both of these questions revolve around what I've just done on the different categories of costs, fixed costs, variable costs, and so on. And what you might want to do is look at the question, pause the video, give your answer, and then I'll give you the answer. I will give you a slight pause before I give you the answer, but you might want to pause me as well. Okay, so the first one, which of the following is not a fixed cost for a bus company? So which isn't a fixed cost? A, B, C, or D? You might want to have a look at those. Which isn't a fixed cost? Pause me now. Okay, hopefully you've got the answer, and the answer is D. The fuel cost for the vehicles is not a fixed cost. The rent is, that won't change. The building's insurance, that won't change. The business rates bill, that won't change once it's been decided. So all of those are fixed costs, but the fuel for the vehicles isn't. Why? Well, because the price of the fuel could change even if we drove exactly the same number of miles. If we have more passengers on a bus, the bus will be heavier, so we'll use slightly more fuel. If we decide to put on extra bus routes, then again, we will use more fuel. So D is not a fixed cost. Okay, answer D. Question 2. If a salesman earns a £5 bonus every time they sell an extra unit of a product, the bonus is an example of what? So 4 answers there. Pick one of them. Pause me now if you want to. Okay, here's the answer. It's an example of a variable cost. It's a pure variable cost because every time we sell an extra unit, then we have to pay this extra £5 to the salesman. So it's a definite variable cost, completely variable, goes up in a straight line as the units of products that are sold go up. Okay, so that's an example of a variable cost. Hopefully you got those. If you didn't, go back, have a look at the video, make sure you understand these terms, this bit of terminology, and then move on to video 2 and start having a look at how budgets are constructed, and I'll see you then.